Since onset of COVID pandemic, sweeping production constraints combined with surging demand in some industries have led to shortages, severe congestion, and soaring prices. Having said that, we'll be discussing on bottlenecks, shortages, and soaring prices in the US economy. Supply and demand imbalances in the US economy have been widespread, prompting inflation to rise to levels not seen in decades. One key contributor to the imbalances is that pandemic induced social distancing, which has led consumers to quickly shift spending away from services and towards goods. This reveals, supported by fiscal stimulus and accommodative monetary policy, real goods spending by households has risen markedly, far exceeding its pre-pandemic trend. Pattern of soaring demand and steep price increases have been seen across many industries and related supply chains. This figure indicates increased demand for goods has led to higher demand for imported consumer goods, resulting in substantial increases in port throughputs that have strained port capacity. Accordingly, shipping sector has been under pressure, leading to delayed shipments and sharp increases in costs. Supply side factors have also contributed significantly to the bottlenecks in the economy. Over the last 2 years, at the onset of pandemic, many businesses were forced to shut down as states imposed social distancing restrictions, and other businesses, expecting low demand, voluntarily curtailed production and reduced their orders for material inputs. Despite most businesses fully reopening and some even producing more output than they did pre COVID, businesses are still working to catch up with the lost production to replenish their inventories. This signifies labor force participation declined sharply at the onset of the pandemic, and recovery so far has been slow and only partial. As a result, broad based worker shortages have been limiting production capacity. And as the recovery has gained steam, have started seeing unusually strong wage increases. This illustrates in many industries, demand and supply factors have interacted with one another to result in more severe bottlenecks, with some still ongoing. For instance, even though semiconductors are being shipped at levels well above their pre pandemic trend, there have been semiconductor shortages in the auto sector, in part due to the siphoning of semiconductors towards other high demand industries, such as household appliances and consumer electronics. Additionally, demand for semiconductors by auto sector has been boosted by a shift toward models that require a higher chip content per vehicle than the average car, such as high profit margin luxury vehicles, which come equipped with more technology, and vehicles with hybrid and electric powertrains, which require twice the chip content of the average vehicle. This demonstrates, as a result of the chip shortages, motor vehicle production has remained well below pre pandemic levels, and consumers seeking to purchase a new vehicle are facing empty dealer lots, long wait times, and elevated prices. And with new vehicles in short supply, prices of used cars have skyrocketed. This displays development in both supply and demand contributed to unusually sharp increases in consumer prices, leading overall inflation to reach levels not seen since early 1980s. Bottlenecks occur when constraints in the production, transportation, or distribution of goods or services led to unusually large movements in price and of shortages of goods and services. This can happen when there is a sudden sizable drop in supply capacity or when demand expands enough such that supply is unable to meet the increase in demand without large price increases. Bottlenecks would not, however, occur when typical fluctuations in demand or supply lead to relatively small movements in quantities and prices. This manifests prices for leisure, travel, and hospitality have moved above the level suggested by their pre-COVID trend, even as spending in these categories have remained disparate, suggesting that this mechanism is at play. Some of the strong sales seen of household furnishings and other durable goods might have been pulled forward of expenditures that would have happened later. In such instances, would expect to see a decline in the demand for such goods, especially as consumption rebalances towards the goods and services split that existed pre-pandemic. This denotes furniture spending has already shown such a decline. However, prices have not yet shown signs of moderation, possibly because of continued pressure from high shipping and input costs. Bottlenecks and inflation during the pandemic were importantly driven by the very strong and rapid expansion of demand during the initial economic recovery, combined with an unprecedented reallocation of demand across sectors and reduced supply capacity, prompted in part by sharp declines in labor force participation. Looking ahead, resolution of bottlenecks will depend crucially on an easing of consumer goods demand, which may follow from a return to the pre pandemic mix between goods and services. Resolution will also depend on the recovery in labor force participation, which can support short-term supply, and strategic investments that can expand longer-term production capacity. If all these developments are realized, may see a slowdown in overall inflation even as the economy continues to grow. Finally, a crucial question for inflation going forward is whether the recent string of widespread high inflation readings raises the prospect of inflation becoming routinely embedded in economic decisions in such spheres as job share, wage expectations, price setting, savings decisions, and consumption choices, including the possibility of feedback between wages and prices, which is the so called wage price spiral. In such an event, even if bottlenecks resolve, on the real side, their effects on inflation may linger. Today's presentation is based on Federal Reserve Note dated 24 June 2022, themed as bottlenecks, shortages, and soaring prices. Thanks for watching.